virtual mastermind. This is a very special one I've wanted to do for some time, and I'm so grateful to all of these fine folks for doing this with me tonight. This is an all-star panel that we're going to go around and talk to in just a moment here. You'll get intros from all of them. But tonight is the state of the multifamily market. We're talking broad. We can get local where it makes sense to. We've got people that have data, people that have knowledge, people that have teams of dozens of people that know what they're doing, that have fed them information so they can provide it to you tonight. It's going to be exciting. It's going to be fun. And I'm looking forward to all of you getting maximum value out of what these guys and gal have given to you. Before we get started, I do want to mention that this content, along with all of our content, lands on our YouTube channel. Simply go to youtube.com/multifamily and more, and you can see playlists on syndication, playlists if you're a newbie, playlists on a lot of different stuff, a lot of different content that hopefully helps you on your investment journey. We strive to deliver maximum value with every bit of content that we put out. And I think, Ben, we've outdone ourselves tonight. Agreed?
I think so. We have a dream team tonight. We're very, very excited to have you all with us and to share your knowledge on the market. There's a lot to discuss. First of all, let's maybe do a little round of table and get everyone introduced. We'll start with you, Julie Peterson from Old Capital. Just, tell us who you are, where you work, and kind of what you do.
Great. Thank you so much. I appreciate the opportunity to be here and to share among these real heroes here with us. So I'm Anne Peterson. I'm with Old Capital Lending. We are a premier provider for debt, not only in multifamily, though we spend a lot of time in multifamily. About 85% of our business is in multifamily. We also look at other asset classes. We do $1 billion a year in transactions. We've closed about 5,800 loans. And so when you come to Old Capital, not only are we going to be your biggest partner, 75, 80% of the transaction is coming from Old Capital, but we also spend time, if you're looking for a deal sponsor or you're looking for LPs, we try and corral. We've got great relationships. We spend a lot of time in different markets. I'm located in San Diego, and I'm here to tell you that there is life outside of Texas in multifamily. So I spend a lot of time in Phoenix, in the Southeast, in the northern part of the Midwest as well, in Tennessee and Oklahoma. We've got a lot to share with you tonight, and I'm so thankful that I'm here tonight. So thank you.
Thank you very much for the introduction. We then have Bard Hoover from Marcus & Millichap.
Hey, Bard Hoover, Marcus & Millichap, based in Dallas, Texas. Marcus & Millichap is a national firm. We're the largest investment sales firm in the country. We have over 2,000 brokers and over 75 offices in North America and Canada. Nick Fluellen and myself run Fluellen Hoover Multifamily. So we're a 19-person team based in DFW. We do anywhere from $500 million to $1 billion in transactions annually and have for many, many years. We have 5 guys on our team now that specialize in secondary markets. And then we have 4 guys who specialize in the secondary markets range anywhere from New Mexico over to Mississippi and up to Iowa and Nebraska. And then we do a lot in Texas and Central Texas. We really don't go to South Texas that much. But we have guys that focus on the larger deals in DFW, and then our secondary markets guys, and then we have 2 guys that focus on 76 units and under. So it's for kind of a starter property, get going in the business before you ratchet up. And so we like to see we have a lot of clients that got started buying 28 unit, 50 unit deals, and now they own 4,000 units. So, but we also invest in deals. So we look at it from an investment perspective when we broker. And so, I'd love to work with any of you guys.
Awesome. Thank you very much, Bard, for the intro. And I think we'll probably touch on the secondary and tertiary market in just a little bit. Okay, we have Chris Nebenzal from Yardi.
Hi, everybody. Great to be here. Ben and Jamie, thanks for having me on the program. I'm Chris Nebenzal. I'm the Director of Research for Yardi Matrix. So we're the data division of Yardi Systems. We cover a number of asset classes. Multifamily is our main asset class, but we also have data on storage, office, industrial, student housing is our newest asset class as well. And our research and our data really covers all of the fundamentals that you'd need in underwriting and property management, asset management. So rents and occupancy, sales and loan information, who owns each of the properties, what do the expenses look like, what do expense comps look like in a given market or a given submarket. And then my job specifically is to take all the real estate fundamentals and marry that with what's going on socially, economically, demographically in a market. So the big thing that we're talking about right now is migration. What's happening in the big cities, the primary markets, the New Yorks, the San Franciscos, the Los Angeleses of the world, and how is that influencing, to Bard's point, the DFWs and also the smaller tertiary markets beyond kind of that secondary tier. So really excited to be here tonight and talk about markets, talk about what's going on in the economy, what's going on in the US from a social perspective as well, and how that impacts multifamily.
Thank you very much, Chris. Very excited to have you here. And then our last panelist tonight is Mr. Terry Judge from Core Solutions.
Last but not least, right, Ben? All right. Well, thanks for having me, everybody. Very excited to be here and part of this expert panel. So my name is Terry Judge. I'm the CEO of Core Solutions Group. We are a specialty tax and engineering firm with a special emphasis on multifamily with cost segregation, engineering-based cost segregation. So we're nationwide. Like I said, I started the company back in 2006. We've done over $1.5 billion now in tax savings. I like to say with zero disallowances. So we're following strict IRS rulings, crossing the T's and dotting the I's, but a lot has changed in terms of some of the new, CARES Act and bonus depreciation. So looking forward to touching on that this evening.
Yeah, there's a ton to talk about when you think about the election and COVID and all of this stuff, the state of the economy, what the Fed signaled. So lots of questions I have, and I'm sure lots of questions that you have out there. So before we get rolling, do this for me. The bottom of your Zoom screen, you'll see a little chat button. Click that. Over on the right of your screen, you'll see something that pops up where you can type a message. I'd appreciate if above that you can change that from to all panelists to everyone, so that everyone could see thoughts, questions, or whatever the case may be. And as you have questions, whether they're relevant to the conversation at the moment, or you just have them even right now, drop them in the chat box and we'll grab them as we go, as we kind of start hitting on that topic, and we'll go from there. For now, just to get it warmed up, I'd love to hear where people are kind of dialing in from tonight. So if you don't mind just throwing your name in and saying where you're from, so we get a sense of the demographic here, like where's everybody calling in from. I'd appreciate that. And we'll get rolling. So let's start. I want to go to Bard to start. And Chris, I want to get you in on this as well. But I want to talk about kind of where we are now versus where we're going. And specifically, we talked a little bit about this already, but these secondary and tertiary markets, right? So first of all, Bard, can you describe a little bit more in detail than you have what a secondary market is, perhaps with some examples, what a tertiary market is, perhaps with some examples, and the direction you're seeing things flow from the broker's perspective, from a buyer's mindset perspective?
Yeah, it's a little bit of an arbitrary term talking about secondary versus tertiary. So everyone has their different definition of it. The way that I would define it is the secondary markets, like I'll take Texas, for instance. There's 4 primary markets, Dallas, Fort Worth, Houston, Austin, San Antonio. And then everywhere else is either a secondary or tertiary. We define secondary as a market that you can fly into. So if you fly to Dallas, then you could fly to, let's say, Lubbock. That's a secondary market, or fly to Amarillo. But there's going to be some towns that are smaller. I won't even say the names because there's a million of them, but that are smaller that you can't actually fly to. So that we would call that a tertiary. So secondary markets we would define as one that you can fly into. In general, I would say we started the secondary markets team on Llewellyn Hoover Multifamily about 5 years ago, because what we saw were there were so many people coming to DFW and they were missing out on deals. And there's only one winner, and we were getting 20, 25 offers, and there were 20 to 24 losers. And so we wanted to find an outlet for them, and the yields were getting skinnier and skinnier, and they're even skinnier today. But so we decided that there's a real opportunity in secondary markets. So that's why we launched this 5 years ago. We've had incredible success bringing these deals to market. I think there's better yields in these markets. I think there's less competition. I think there's less sophisticated competition. So the upgrade programs that you see in primary markets where you can go in and spend $5,000 a unit, get a $150 rent bump. It's not really, it wasn't being done. It's starting to in these secondary markets. So you can be a kind of a cavalier, a first person to go into these markets and upgrade these units, upgrade these properties, and get a premium for it. So we saw it just explode. And so, I mean, we see, you know, I mean, some of the unsophisticated owners in these markets that you have the opportunity to buy from is mind-boggling. We're selling a deal right now. I won't say which one, but the owner has never done a rent survey. So he has no idea what his competition is charging. I mean, it's stuff like that that's just crazy. And so I think there's a lot of opportunity. I think there's a migration, like Chris alluded to, from a lot of people that are moving into these markets. The cost of living is less, the quality of life is better. People are now being able to work from satellite offices from their home. So we're seeing that even happen more now that COVID has started. You know, there's some different metrics you want to look for in secondary markets. I think healthcare, number one, education, number two, and then number three, which is just a bonus, is technology. And so if you have 1 and 2 with good healthcare and good education, I think it's a valid market. We're seeing, Chris can allude to this, but we're seeing population growth and job growth in these markets like we had not seen 10 years ago. There was actually 10, 15 years ago, the population was dropping a little bit, but we're starting to see it come back. You know, there's just, you can get cash flow and appreciation in these markets now. Cap rates have compressed, although they're less than primary markets. They are compressing now, so you can get a pop on the back end. So, I mean, that's kind of my overview. We think there's incredible opportunity in secondary markets. And so that's why we have 5 guys delegated to solely doing that on our team.
Okay. And we might come back to you on this because you made a couple of points. I want to go to Chris real quick to get a little bit more data centric, I assume, at least coming from Yardi. What are you seeing as far, well, you know, speak to the same question about secondary versus tertiary markets, and what are you seeing from a trend perspective? And then I have a follow-up question on sustainability, but I'll wait for that so I don't bombard you right now. But what are you seeing from a trend perspective, population trends or whatever the case may be?
Sure. Yeah. So I'll try to use similar terminology to what Bard was talking to, and I'll throw out another term that we use looking nationally, and we'll call them the gateway markets or the mega markets. Those being New York, San Francisco, Los Angeles, Chicago, Boston, and DC. And really what we've seen since COVID, and actually pre-COVID, this trend started with the 2017 tax reform, especially in California, New York, Illinois, high tax states where the cost of living was incredibly high. It was harder now after the tax reform to write off as much taxes in home ownership as you could. We started to see this trickle of migration leaving New York for the Carolinas, for Florida, for Nashville, Tennessee. We saw people leaving California for Dallas, for Houston, for Phoenix, for Denver. Chicagoans were moving out as well. And this really just accelerated when COVID hit. And what we've seen is that rents and occupancies have taken a nosedive in those markets in the past 6 months. And we're talking about big occupancy hits in markets where occupancies are usually well above the national average, 96, 97, 98% in a New York or a San Francisco. Occupancies right now are in the low 90s, high 80s, as people just said, I'm out. You know, it's too congested. The reason that I love Manhattan, the restaurants, the arts, the culture, well, none of that existed for the last 6 months. So I'm either going to move to a Westchester County in the suburbs, or I'm going to say, I'll move to Raleigh, I'll move to Dallas, I'll move to Austin. And so as Bard was saying, you know, we're really seeing that migration trend. And that's certainly been a help for a lot of what Bard was referring to as a primary market, a DFW in Austin, a Houston, those markets that aren't the gateway cities, but I would throw Denver in there, I would throw Nashville in there, Orlando, Charlotte, some of these big diverse economies that are in other states, not just California, not just New York, not just Massachusetts. So the migration trend has been incredibly helpful for these type of markets. And then what has happened there is that it's allowed fundamentals in real estate to really sustain themselves. COVID definitely put a damper on rent growth. If you were underwriting it at 3%, 4% rent growth in some of these markets like a Denver, a Dallas, or an Austin, maybe you're flat this year, maybe you're flat next year, but you're not declining the way New York and LA are. and then going into those secondary or on a national scale, what we would call tertiary markets, a Lubbock, a Waco, San Marcos in Texas, Colorado Springs out here in Colorado, you're actually seeing pretty strong rent growth. And to Bard's point, you know, people can work anywhere for the most part right now. Why wouldn't you choose to work and live where it's a little bit more affordable, a little bit less dense? If you like the mountains, you know, you don't have to live in Denver, you could live in Colorado Springs. If you like kind of what Texas or the Carolinas have to offer, you could move to an Asheville, North Carolina, rather than be stuck in Charlotte. And I think there's really kind of a reckoning going on right now that the talent and the technology doesn't have to be in Silicon Valley or Manhattan or the research triangle or the research headquarters in Boston. There are people at a number of different firms, a number of different industries working from home and working from anywhere and doing it quite successfully. And so I think you'll continue to see that as we move through the balance of this year into next year. And it really has an opportunity to reshape the multifamily universe. When you think San Francisco rents are at $4,000 for a 2-bedroom, $5,000 for a 2-bedroom per month, you could get the same thing in Denver for $2,500, same thing in Austin for $2,000, $2,500, the same thing in a tertiary market for $1,500. Why wouldn't you do it? So I think that's that trend of the outmigration from the big cities into this kind of primary or smaller market and then into the secondary tertiary market is going to continue.
Interesting. I wonder a little bit, by the way, a fun fact, the word tertiary got me knocked out of the spelling bee, the state spelling bee. So that word just sends a chill up my spine every time. I got cute. I could have spelled it, but I spelled it wrong.
Was that last year?
It was
that
2
last
years
year's
ago.
bee?
2
Okay.
years ago. Yeah. It was, rough time. But you mentioned the phrase just now, or right now, I should say, a couple of times. Right now, this is what's happening. Right now, that's what's happening. As a native New Yorker, I remember back to the 9/11 days when that event created. It seemed, I wasn't in the data like you are. Maybe you have some data from that time, Chris. I don't know, but there was a migration. People get out of these cities, with the state of the way things are going, or whatever the case may be. But people seem to have a short memory because there was a flocking back to the cities at some point. And this seems different. COVID is different, right? It creates virtual. Zoom wasn't around back then for us to be able to get connected this way. So maybe it is, maybe it isn't. But is this a time when you would say, and Bard, I'll go to you as well on this, but let's start with you, Chris, and then Bard. Is this a time where we should be looking at some primary markets like a New York, like a San Francisco, these coastal cities as coming up on a time of cap rate expansion, prices dropping, buy now, because in 2-3 years, you're going to be back to $5,000-$6,000 a month rents? Or do you see this? And I know you don't have a crystal ball, but does the data tell you, or does it indicate to you, or whatever you're seeing, that this is a long-term sustainable trend? These cities will continue to deflate and you should stay out of them.
Yeah, I would say this is a different go around than 9/11 and the financial crisis for a couple of reasons. One, the pandemic has really impacted everyone across the country, across the world. And it's also lasted a lot longer than September 11th was a very concentrated event.
Yeah.
The great financial crisis was also concentrated in that it really hit the financial industry and the financial markets. It trickled down into the home ownership market. It trickled across a number of different industries, but it was really concentrated in one kind of dedicated area. I'm not here to tell you that New York is going away, that LA is going away, that San Francisco are going away. But what I see different this time is that the longer COVID lasts, the longer this work from home experiment experience lasts, and the longer that it becomes successful, I think the stronger these secondary and tertiary markets are becoming, and the longer the staying power will be. The other thing that I would point to is that there are significant climate and significant local regulatory concerns in California, in New York. The climate concern is across the East Coast, but the regulatory concerns in Illinois, in New York, in California. I know, Terry, you're going to talk a little bit about taxes, but there's a significant barrier to entry when you look at the state of a municipal finance department in a Chicago or in a New York. I don't see how taxes can go down necessarily in those markets. And that's going to be a big inhibitor for the regrowth of those markets.
Makes sense. Makes sense. Bard, what about you? What do you see in this regard?
Well, I agree with Chris. I think I think they're going to have to raise taxes. I think they've lost so much revenue from all these companies moving out, and now these individuals are going to be moving out and working from home. When you could live in San Francisco and work for this tech company and make great income, but you're paying $5,000 a month to live there, but now you can work remotely. Why would you not move somewhere like Chris alluded to and live for $1,500 or $2,000? And I think that could stay. If these companies allow people to continue to work remotely, they're going to lose a ton of population. We've seen when there's always been a big migration from a lot of these coastal markets, gateway markets, as Chris alluded to like DFW. But we're seeing even more now. We are getting inundated with phone calls of people basically saying, "I've had it. I'm done with it. All of the riots, the politics, the new laws that they're imposing out there." I mean, in California, they have Prop 15. Where they used to assess taxes, and Terry could talk to this, assess taxes upon sale. Now they're going to do it every 3 years. And so their tax bills are going to jack up. Prop 21, rent control. I mean, they're floating all these things out that are not landlord friendly. And so I think that they're going to have to, those people are going to have to pass it on. Something's going to have to give. And I just think there's more people that just feel like there's more chaos there. And they're just going to move away. And will they move back if they move to Phoenix and settle in and get comfortable and they have their family growing up there and they like it? Why would they go back? Yeah. And then when you crunch the numbers, it's tough. It doesn't make a lot of financial sense. Yeah. I see this as staying. I really do.
Yeah, I debate. I'm not sure. Like, I agree with you. I don't think the person that moves to Phoenix returns, but the next generation that comes up, short memory, or do they start to say, I want New York, I want San Fran? Does it start to build up? But I don't know. It's going to be interesting to see. And I know no one has the crystal ball. Chris, you wanted to get a point in, and then I had one final question for you for a moment, but go for it.
Sure. Yeah. And you mentioned kind of the generational thing, and I think that's key. What I've noticed in the work from home experience and the migration trends that we're watching is that millennials are certainly driving the workforce right now. And I think what was appealing and sexy about New York and San Francisco was for a previous generation that people were willing and wanted to work, and we're in a culture of working nonstop hours in the center of it all, right? And millennials, I think, are saying, you know what, I would prefer quality of life over that extra 5%, 10% in salary. I want to be in Austin. I want to be in Denver. I want to ride my bike. I want to go skiing. I want to go rafting. I want to have this experience outside of work. And now that they're saying, oh, wow, I can do this from home. This is fantastic. And Bart, again, to your point, it's not a difficult equation to say, all right, my rent is $5,000. I'm going to take a 10% pay cut for a 50% cost of living. You don't have to be a rocket scientist to figure that out.
It's a great point. That's a great point. It's fair. It's a fair point. It's going to be interesting to see what goes on over the next couple of next many years, I should say. But I think you're right. I think short term, meaning the next few years, I think we see what we're seeing, and it's going to continue. I want to go over to Terry and Julie a bit on some post-election stuff, direction of the Fed, all that. But Chris, I do have one last for this area, for this part, question for you that I wanted to get your thoughts on. Everyone knows about Dallas and secondary markets like whether it's, I don't know, Fort Worth's considered secondary, but whatever. Secondary markets within a state like Texas, primary and secondary markets, and the migration to Phoenix, to Florida, Arizona to Florida, to the Carolinas, all of that. What is your data showing, if it is, as that next emerging market? And it may not be an app, or maybe the few next emerging markets. What is your eye on that maybe people aren't quite as tuned into right now? The Dallas, I keep going, the city, the Texas, the Arizona, the Carolinas, the Floridas, get it, hot, great. You can find markets within them that are great. But is there anywhere else that you're seeing right now that's really starting to trend?
Yeah, a couple that I would throw out there, Huntsville, Alabama is red hot. Colorado Springs is growing incredibly quickly, and Boise. And Boise is kind of a bit of the lone wolf out there. There's not a whole lot close to Boise. I know the tech companies are starting to move to Boise, and it's kind of becoming the Silicon Valley of Idaho. But Colorado Springs and Huntsville both have relative proximities to other bigger markets. And I think that's what you look at. I would throw out a San Marcos in Texas as well, where it's not like, okay, I'm going to go to a far-flung tertiary market, but Colorado Springs on a good day is only an hour and a half from Denver. And the whole I-25 corridor along the Front Range in Colorado is really expanding. The Texas Triangle from Austin down to San Antonio, Houston to Dallas, well, that stretch from Austin to San Antonio is really kind of turning into one metropolis as well, and San Marcos is right in the middle. So a San Marcos, a Colorado Springs, even a Castle Rock, which would be considered part of Denver, you've seen incredible growth recently, because it's like, okay, I can go to Austin, I can go to San Antonio, I'm in good proximity. I could go to Colorado Springs, I could go to Denver, and you're really seeing kind of these offshoots of other markets, of other bigger markets, I should say, where the tertiary markets are really, kind of shooting up.
Yeah.
Not to dish on other markets, but say Topeka, Kansas, or Des Moines, Iowa, it's really its own economy, and that market will live and die on the growth of that economy. Whereas some of the fastest growing tertiary markets are really getting the benefit of the local economy and the expansion there, but also kind of the drift effect in a San Marcos or a Colorado Springs example.
Interesting. Yeah, I'm in Austin right now, as I told you guys, visiting. And I think the stats here are about 2 million in population and maybe about 1 million in growth per decade for the next 2 decades, just in Austin. So I think there's a runway still, even in the primary markets within states like Texas and Arizona. But I think some people get, and me too, some people feel like everyone's zigging that way. So I got to zag to another place. And it sounds like that zag are places like Boise, Colorado Springs. So I appreciate you saying that. For those of you watching right now, I'd love to hear some reactions from you. Type in the chat. And again, drop questions in there. Let us know what questions are coming up. It's been pretty quiet. This isn't normal for our virtual mastermind. Maybe you're being overwhelmed by information because it's incredible information, but drop questions in there. Anything's relevant and we'll get to them. Chris, you talked about for a moment the 2017 tax reform, and I thought that was a good transition to talk to our friend Terry Judge a little bit, because you're a resident tax guy here. Not necessarily, but you're our cost seg guy. So 2017 tax reform, I couldn't speak to it as much as Chris could, but I do know that we've got an election coming up. There's things like bonus depreciation and enhanced or accelerated depreciation that have been very, very good for real estate investors. The real estate investor designation is out there. That's been good for real estate investors. What are you seeing? What are you anticipating? What are you seeing? Start with this. Define cost seg and what it is exactly you do quickly, if you could. But then go into what you're anticipating. What does the election mean for you, one way versus the other? Can you give us a little bit of color there?
Yeah. So cost seg, real quick. There's 2 pathways in the tax code. One is the straight line method, and the other one is cost segregation, and that's just a form of, you can write your building off, your multifamily property off much quicker. So instead of letting the building depreciate over the normal life, 27 and a half years, we can actually write that building off over, let's just call it 5 years. So my thing is, why would you let the IRS hold on to your money for 27 and a half years when you can put that money, in your pocket using depreciation, using the tax law, to offset ordinary income to make your property, your investment property, ultimately cash flow even greater. And I like to see, more and more people now are starting to put cost segregation in part of the planning, being part of the financial puzzle. So, instead of always an afterthought up until, just really the last couple of years, people are starting to move it into the planning of the property, building it into the ROI, which is great. Usually it's always been, something that, the IRS does a horrible job at promoting. A lot of CPAs across the country don't do this in-house. And, but, to this day, going into, it's been in the tax code since 1969. It's been the gift that keeps on giving. And whatever side of the aisle that you are on, there's a lot of wealthy Democrats that own a lot of property and they love depreciation, whether they admit it or not. Mm-hmm. And we know, President Trump, the reason why he pays $750 in taxes for the last 2 years, whether that's true or false, he leverages cost segregation to the fullest. And so it is, we from a firm, we always just try to provide this education, because now there's layers upon layers upon layers on how to maximize cost segregation. Going into after the election, who really knows? I do know that if Trump wins, it will be in the tax code for the next 4 years, for sure. It may be enhanced. If Biden wins, we don't know. He's already talking about that he wants to eliminate the 1031 exchange program. He wants to close off loopholes, for the wealthy. He wants to shut down certain areas of depreciation. Whether that's cost segregation or not, we don't really know. But there could be some massive changes coming up if they, if they do take over. So we're advising our clients, if you own buildings, it's now's the time. You want to maximize. You want to, because again, who knows if it'll be faded out, weeded out, grandfathered. It may remain. It may remain the same. I will tell you there will be incentives around green building, and who knows if that could be an initiative that still allows depreciation on energy efficiency. There's been something that we've been involved in called the 179D, and it is a federal deduction, and you can actually write off certain elements that we could not write off using cost segregation, other long-term assets. So anything with HVAC, energy efficiency, renewable energy, LED lighting, any type of technology, any type of equipment that now can qualify, it's still in the tax code, by the way, up to $1.80 a square foot in the form of a tax incentive for buildings going green. So I only see that portion of the tax code exploding with green initiatives, which is exciting. I think that's kind of down the middle. That's a good thing, right? I mean, that's a good thing to reduce our impact as far as carbon, reduce energy, and that's a big line item, even for multifamily, on electric, gas, water. So if we can impact that. So anyways, that's a little bit my viewpoints on some of the tax incentives that I see coming and hopefully not going, because again, cost seg, we've been doing it for 15 years. It is the #1 tax strategy for real estate investors. It is the 8th wonder of the world, no question about it. And I can touch on a couple different things, Jamie, in terms of active investing, passive investing, depends on how deep in the weeds you want me.
Yeah, let's get to that in one second. I want to touch on this real quick. I want to make sure I'm clear, but the 176D, 179D, what was it?
179D.
You've said it to me a million times and I can never remember.
I know,
My
it's okay.
apologies. But 179D. So how does your firm, as an investor, I'm like, oh, okay, cool. There's this energy tax credit thing that's out there. To your point, exists probably no matter who the president is, maybe accelerated if Biden's elected, right? Because it's a green initiative. Yeah. What does your firm, what do I come to your firm and say if I have a property that I'm thinking, oh, I want to go green? What do I do right now? How do I call you and we talk about what do you offer up in that regard?
Yeah. So, we do a ton of pro bono work, Jamie, as you know. If anybody has a building and they want to see what's available, we'd be happy to run some numbers. But essentially, we're looking at if you are replacing the HVAC, heating and cooling in the building, if you are going to be replacing or upgrading the lighting in the building, if you're going to be impacting the building envelope, then you may qualify for the 179D program. So there's some economics, there's some square footage requirements. There's some other requirements, but that's what we do during the discovery to see if you would be a candidate for that. Now, I will tell you that it is expiring at the end of the year, which is right around the corner. Will it be extended? It's already been extended. Actually, it's already been extended twice in the tax code. And will it be extended going forward? Who knows? We don't know.
So take advantage now is what
we're taking. Saying. Yeah, we're really telling our clients, like, if you've got real estate, it's time to pony up or just get this done, get this into action.
Okay. Let's talk about real quick this. You mentioned about LP versus GP, and there was a question in here actually about Austin being expensive. How do people buy and make a cash on cash return? That's an interesting question, but I think a lot of people buy as limited partners in a community like that, like in a market like that. These are Class A, big, beautiful properties that people usually invest their money in to somebody else running the property. So if I'm a limited partner versus an active partner, talk to me about taxes, the tax code. Does it benefit me? Do I still benefit from bonus or cost?
Yeah. So let's talk about limited partner. I'm a limited partner in a real estate investment. And so, if the property, the GPs are going to do a cost seg on that property, it will be spread out through all of the LPs as well. There will be accelerated depreciation that you're going to be able to take advantage of, and that's going to show up on your K1s as a loss. So everybody benefits across the board, depending upon your percentage in the deal is the allocation that you're going to get as a part of that investment strategy. Now, going forward, after September 27, 2017, you now get bonus depreciation. And that just means, you know, in the world of cost segregation, you know, we're breaking the building down into 9 components or 9 units essentially. And you're really getting, you know, 5-year bucket, which is all your interior. Okay. And then you're getting your land improvements, which is your 15-year property. So now with the new act, and this came out of the Tax Cut and Jobs Act, you are now able to accelerate or compress all of your 15-year short life property and all of your 5-year property into year one. That's what we call first year 100% bonus depreciation. So you're just getting this big bump in year one. So let's say if we buy $1 million property and the down payment is, let's say, call it, you know, 200 grand, your first year tax savings is probably going to be around $250,000. So you're essentially writing off your down payment in year one. So it's become a real game changer. It's obviously very attractive, and whatever you don't use, it still has a 20-year carry forward as well.
I love it.
Yeah, I mean, it's just it's an absolute no-brainer, home run, and you know, it's good to see the impact that that's going to have on a limited partner. Now, if you are considered an active investor, right? So you have X amount of hours that you're putting into your real estate business, even if you have a W-2 job, or you can use the depreciation that's from the cost seg, and you can use it against other income coming in from other properties, or you can offset your W-2 wages. So as you're on the fence, you're like, God, I love this multifamily stuff. I want to go full time. And as you start offsetting, let's say you're a high income earner in your W-2 life, and if you can offset that income by using depreciation, well, guess what? You might be able to go full time a lot quicker than you thought. So just that type of planning is huge, right? To accelerate your real estate investing career using cost segregation. And sometimes, you know, you may not need to do a 1031 exchange. 1031 exchange, by the way, goes hand in glove with cost segregation. It's a planning tool. It's a timing tool, but you can use the depreciation from a cost seg. And let's say you're up, you don't want to be stressed out over the timing that you have to find that next property, and you're going to have to overpay for that next property because you want to defer. You could use the depreciation on the new purchase to offset income on the old purchase. And that becomes a very powerful tool. So you have another way to use cost seg if you, in fact, don't want to do a 1031 exchange. So there's some planning on that piece of the puzzle.
So Barry, I've got a question. Sorry to interrupt. I've got a question about, depending on who becomes president, is there a threat that this goes away? Either the 1031 exchange or cost seg, or it's modified in some way, specifically.
Yeah, so Bart, I as I mentioned on my intro, I was saying that, you know, if Biden does win, he's already talking about closing down 1031 exchanges. It's already on his website. It's already in print. I've already read it. And then to follow, I'm sure he would start seeking out the depreciation that we also, you know, love, and it's so near and dear to our heart. So we'll see how that plays out. But yeah, there is a threat that would go away. So that's why I'm starting to invest heavily in the multifamily.
Makes sense. Makes sense.
I'm like, man, I might need a new job. I don't know. But,
So let's talk about this from a standpoint of, you know, and we'll do this, then we'll transition to Julie to talk a little bit more about some of the lending, what's coming up in lending. But as I think about state of the market, right, and what you just discussed was essentially, hey, if you're on the fence with do I not cost seg a building that I own, because it may go away. It may go away very quickly here, right? So, or it could be modified to be less desirable or less effective, bonus especially, right? So do it. The other part of this is that prices are going up, especially in markets that Bart talked about and Chris talked about. Prices are going up. returns are harder to kind of make attractive to investors. And I think, again, going to Chris's question in the Q&A about Austin's expensive, how do you make it work, essentially? And this is a I don't know question, but could, if somebody was proactive enough in saying, hey, Terry, I've got this building under contract, I've got my pro forma set, but I want to know what the cost seg benefit would be here, what the depreciation benefit would be here. You could do that survey. Could they then include whatever that benefit might be in the returns of the pro forma for their investor base? Is that something that people should be thinking about doing? And can they, and have you seen them, include the benefit that you give them in their pro forma?
Yeah, some of the sophisticated, syndicators out there are really starting to take it to another level. They're using our benefit analysis to build that in. They're using a net present value, let's say over the next 5 years, to depreciate that building and then use that to offset. So whatever the ordinary income tax bracket that somebody is in, they could still be over a 35% tax bracket, which is huge. So if you could mitigate that and wipe that out for the next 5 years, depending upon, obviously it's all tied to the purchase price. And you can use that, put that into as a line item on the prospectus and show investors what that depreciation number can be and how that can impact the cash on cash and the rate of return, for sure.
There's a good question in here before we move on from David. It says, your recommendation on cost seg and depreciation for a guy who has smaller income but large real estate portfolio. I think he's saying it here, most investors have a large income to offset. So he's saying, if I don't have a lot of income to offset, but I've got a lot of stuff that I could depreciate, what's your thoughts, your advice? Or how should they leverage this, or should they keep the depreciation or carry forward for the future?
Yeah, I think that comes down to them and their CPA. We're not a typical accounting firm, so I think they have to get with their CPA. The CPA really understands where they're coming from and where they're trying to go. I think there's that economic kind of review that needs to be had, and we can help run those numbers and to see, because it all depends on what the property is kicking off in terms of net income versus debt. Maybe the first year when they first put that asset under contract, maybe it isn't the right time. Maybe they should wait 6 months, a year before it gets, maybe it's fully out. They need to do some renovations, so they're going to have more costs. Maybe they need to wait before it gets fully ramped up, then do the cost segregation study. I mean, rule of thumb, once the building goes into service is the very best time to set those new depreciation schedules, put them on steroids, and get that building accelerating rapidly. And I will tell you, it's kind of funny. The IRS actually looks at cost segregation now is the proper way to write your building off, and they look at the straight line method now is the improper way to write a building off. That's why audit risk has really gone down, and this is not considered aggressive. I've had so many people like, oh, Terry, we don't want to take all this depreciation. We're going to get audited. And that's really not the case anymore. And what's really cool for the folks listening that maybe you've had a building you've been sitting on for a couple of years, and Jamie, that's the perfect scenario just to segue into this. The IRS will allow a one-time catch-up where we can go back in time. Actually, and this is funny, we can go back to 1987 legally. We don't go back that far anymore, but in the tax code, it says 1987. But we'll go back to the early 2000s, and we'll do a cost segregation study and pick up all the missed depreciation, and the client gets to take advantage of all that new depreciation in the current tax year without amending returns. It's an automatic consent by the IRS. It's called a 481 adjustment, and we do these all the time for families that have been, maybe they've had this property for 10 years and now they need more write-offs, and we will do a cost seg study going back 2, 3, 4, 5, 6, 7, all the way back, maybe even 15 years. And that new depreciation, that newfound depreciation will carry forward into the current tax year, and then they can use it to offset and then to carry forward for 20 years again. So there's just another planning tool that you do not have to amend. That's another myth in cost seg land. You do not have to amend returns, because that would be a nightmare, especially if you've got multiple investors, on the deal that have different CPAs. It's like, oh my God. So we can help orchestrate that behind the scenes and actually run an analysis on what that would look like. So, yeah. So, and I got one more thing to share. Go for it if we have time. Yeah, go for it. I don't want to take up too much time.
No, you're good. You're good.
So now with the CARES Act, there's one more caveat that they came out with, and so if you do a cost, it's called net operating losses. A lot of people understand what net operating losses are. You can take the depreciation from a cost segregation study. You can go back 5 years and use it to now actually, if it makes sense, you can you can actually amend your returns by going back 5 years and file for a refund and actually get a check from the IRS plus interest. And so for those of you, so obviously pandemic, COVID, big deal, that it's affected a lot of people. So this is some, a newfound way of getting money that you may have never thought existed, right? To come up with extra money out of the air, you can leverage your property or a new property to go back and pick up going back, and you can pick the year, you can go back and file an amended return. And that's what some of the, so again, get with your CPA, because we don't do amended returns, but we will do the cost seg, and you can pull it back 5 years. And that just kind of came because of the pandemic, because of the COVID. And so that's very, very, just another layer of tax planning that could be, it can make a big impact to the bottom line.
Makes sense. No, that's great. And we've got a question we'll try to get to a little bit later on cost seg that popped up here in a second ago about recapture. But I want to move on to Julie and talk a bit about kind of similar in nature. So right now, meaning, the politics of it, what the Fed is doing, all of that. Right now, rates are ridiculous. That's probably the best way to put it. I've shared with all of you and anybody that's watching, Ben and I just refied sub 3% on a property, on a multifamily property. It's very, very attractive. And I wonder about, with what the Fed signaled around inflation, with the election coming up, with all that's going on right now, Julie, just sort of opine, if you would, on what you're seeing now and what you anticipate as we move forward into the end of the year, post-election, and into 2021.
Yeah, thank you so much. So, a lot has changed since March 11th, 13th, whatever it was when we shut this place down. And, we saw immediate spike in our interest rates to really protect us because we didn't know what was up ahead. So in that, we also put in those reserves. We had reserves, we had taxes and insurance. We had all of these collected, $1 million, $2 million, depending on the size of that transaction. And it really caused a lot of problems. A lot of people taking their foot off the gas and saying, I'm not working. I'm going to just stop right here. And we interviewed 4 very good operators, and they, have long years, 30 years doing some multifamily. And they said, hey, if you had a 200 unit building in Texas and Dallas, whatever, how would you finance it? And they said, you know what, we'd probably go to bank financing. If we were going to do it, we'd do bank financing. So, the problem is that with the SBA loans and coming on board with the CARES Act and the PPP and all of that, a lot of these banks shut down. So not only were we not doing a lot with non-recourse, but then the banks were not available. So a lot of people just kind of have been sitting back. Probably 2, 3, 4 months ago, there was I'm going to go buy a COVID deal. And, every month, let's see what happens in April. Let's see what happens in May. Let's see what happens in June. And we did not see much of a decrease in the NRI. So, we're trying to think, okay, what's going to happen now with the stimulus package? And, I have to think that when the Fed say we're holding the rates as low, we're at a record low. I mean, we're lower than 1955. This is incredible transactions that could take place if we could just get a hold of them. There are so many people in this space right now that, we sit around and we say, okay, we've got a ton of syndicators or investors trying to get into this. Where are all the regular investors that can, that are feeding these deals? Everybody's in it. We've seen some go back into single family. We're seeing industrial and storage being huge. Yeah. With the interest rates being as low as they are, we were at 2.76, I think, back in 2019, and now we're at 0.6 on the 10-year Treasury. It's huge. So we're seeing a change in some of the products that we're using. There's, with that consideration of not changing the interest rates, we're seeing Freddie floaters, a floater type product being really, really advantageous. You put a cap on it and you can sleep at night. let's say you put a 5-year cap on it, 3-year cap, whatever you need, based on your performance and your strategy or your business plan. This is a great solution. And we're talking in the 2s. You got 1 year that you're locked out, but you have a 1% to get out. And so we have not seen this. But what we do see is that, does it really make sense for people to be going after Class C product? I mean, how much work does it take to do that rehab component? And yeah, interest rates are low, but what about finding a younger product? Something like in the 1990, late 1990s, early 2005, where you have the new energy saving, you have new construction, you've got new all the plumbing and all of that stuff.
Yeah.
Okay, those things, you're not dumping in money every year, every month. So we've seen a lot of a transition away from C because of the compression of the cap rates. And we're seeing, why not stay in a Class B when if you're short term, you're in it for 5 years. We are seeing that that's moving potentially into 7 years because of the rents coming up. So, inflation, we're going to really try, if we can, if the unemployment doesn't start to go, we're going to try and push our foot on the gas to keep from raising that inflation. At least right now we're at 1. And if we can keep it at 2, the way it's going, I think we'll be okay for now. But really what we're needing is to see a vaccine. I think that's really going to make a difference for so many facets of finance and multifamily, and certainly retail and office space.
How? Can you go into that a little bit more?
Yeah.
What is so 2 questions on the vaccine from your perspective. See a vaccine or deploy a vaccine? Does it matter? My theory is, once there's a known vaccine, the way I see people now, like they're sick of COVID. Oh, there's a vaccine coming. I'm cool. I'm back out in the world. Like they don't need it administered. They just know that it's coming, that it's been approved and it's going to be coming. But your thoughts on that?
Yeah. Well, I think that there is sorry.
I was going to say real quick. And how does it change lending, the market, from your perspective?
Yeah. Well, I think that the certainty, the piece of certainty that, hey, we've got something, we've got people going back to work, we're having people in hospitality. Yes, I think the net migration, especially out of California and going to these smaller tertiary markets, is making a big difference. The question I would say is, how long are these people going to be staying away? We've seen such a growth in the Midwest because where these people are not on top of each other. Michigan is, it's considered a standard market. You're getting very good LTVs in that market. And so I think that there's some great opportunities. And once the vaccine and the certainty and these people getting back into it, the question was, and I posed this to other people, like, oh yeah, the Fed says it's going to be 3 years. And we have seen where that's happened, where the Feds have held it off for 5 years and then we had another extension. But if things start to pick up, are they really truly going to keep it at low
0
interest rates? I think I'm not an economist. I can't tell you yes or no, but I think that if we can keep the inflation from going skyrocket, that we can keep it at bay, that I think that there are opportunities for, growth in these smaller markets.
Yeah. Averaging 2% or trying to get to an average of 2% means allowing 3.5% and kind of like unfettered, right? So at a certain point, they have to do something to deflate. And I agree with you. I think if things turn around, 3 years sounds great, but I have a feeling that it'll turn around. On this point,
that's the uncertainty.
Well, I'm sorry.
That's the uncertainty, really.
Right.
Who knows?
Yep. So right now, I'm just thinking through this a bit from your perspective. So right now, when somebody's coming to you, they can expect, it sounds like, favorable loan to value, favorable rates, favorable terms. Is that fair? And if it is, what do you need to see from an investor in this market to get the best of the best, or even pretty damn good?
Well, you know, there is some concern about, you know, these C properties, affordability, and the different markets. So we are seeing, and we don't know how this is going to continue, but we have seen some deterioration on those collections. And so while you may have 90% occupancy for 90 days, what do you have with people's shoes at the doors? Are there people in those units? Are they paying? How much are they paying? When will they continue to pay? You know, we've seen, you know, Texas, I think, ran out of the stimulus the last I checked, and some other markets. So how are these people, if they're not getting the stimulus and they're not getting back to work, how is that, how is that going to look? And so when I think about where are we going? Where are we going for the future in terms of, yeah, we've got low interest rates, but we've got these reserves, and are we really looking at these tertiary markets that they can return 10% that we've seen in these larger markets? Is it responsible? Is it reasonable? And so when we're looking at these newer markets, you know, 70% is, you know, 70, and again, you're looking at debt service coverage that we need to be really clear about. You know, we did raise them, so where it wasn't a standard or a top market was at 1.2, and with COVID, we've increased that, just so that we've got some sense of control and leverage in the deal to keep it healthy. Because again, we were on a trajectory, right? 10 years in an amazing market. And this is, as we've all said, it's a health crisis. It's not what we would normally see in a recession. But with that said, we do need to be really careful. And at 70, 75, and we are now seeing 80% in some of these top markets. But it is really competitive. As you all know, I'm doing a lot of retrading on deals. And by that, I'm saying it gets assigned to somebody, and, you know, a month later, that guy can't come through, and it gets to my customer, and, you know, things have changed in the market or in that property. So the performance, we're looking at it. We're looking at who's living in these properties. Is it the people that are in the hospitality? Is it, you know, are these the affordable housing clients? So we're taking a look at some of the things and really going deep.
Okay.
And can be frustrating for these buyers.
Sure.
Well, and I'll comment on that real quick, Julie.
Please.
You talked about competition and buying a little bit newer deals. I think the problem with that is that there's so much competition. And when we have a newer, nicer asset, there's 35 offers, and King Kong's going to win the deal. You know, so all these other investors, that they really don't have a chance. This guy owns 10,000 units. He's going hard with $1 million day one. I mean, so it makes it very difficult. So I think a lot of times the opportunities still have to be in B and C assets. And I think as far as, you know, are they paying and everything, it depends on, you know, the tenant profile. And if you have a rough tenant profile, then it's struggling. If you have a strong tenant profile, then they're still doing really well. You know, so less competition in those, just kind of like secondary markets, less competition. But to buy a nice, shiny Class A asset in a primary market, it's tough. There's a lot of people going after them, and the big dogs always win.
Grant Cardone, damn you. So,
yeah. You know what? I will make something, and
please.
Everybody's targeting Texas. I mean, it's growing by leaps and bounds, and no doubt. But keep in mind, the taxes they're going up. They're skyrocketing, and insurance is skyrocketing. And so, you know, we talk about, okay, if you could go to Phoenix and you're paying 100, 180 for something where you don't have those, you know, the taxes and insurance, it may make better sense. So don't.
Absolutely.
Yeah.
I completely agree with that. I invested in a deal with Nightfest. David Moore's a good friend, and in Phoenix, and we're paying $200,000 a door for a 2004 construction deal in a good location. That same deal would be $140, $150 a door. And I'm like, David, why? And he's just like, just look at the taxes, man. And it's a $50,000 to $60,000 per unit delta because of that. It's incredible.
And insurance. And insurance as well.
And insurance, exactly.
I mean, just crazy. They don't have wind and hailstorms. So,
So Bart,
yeah.
Bart, I'm curious real quick, because you mentioned this and I'll kind of go back around here. By the way, it's top of the hour. We're going to keep rolling. I think there's a lot of great content here. We're going to do a little bonus time. So keep your questions coming and we'll get to some of the ones that are in the chat group here. But you mentioned, A-class market, good luck, right? The big boys or big boy, one guy, two guys are going to really take that down, or gal. You mentioned secondary and tertiary markets. I get that. What's the lane that the least people are in from not only a market standpoint, but maybe a size of asset or type of asset or whatever the case may be? And look, maybe even you tell me, I know you're multifamily, but is it outside of multifamily within the commercial realm? But I'm just kind of curious where, if somebody's out there going like, I can't find anything, where might they be best able to find something? Not even like specifically, you can go this town, this, whatever, but what type of market, what type of asset, what size, or whatever the case may be. I'm kind of curious what you would give advice to if somebody's looking to get something done with the lease company.
That's a tough question. I mean, as far as the size of the deal goes, a lot of people like scale. So we just launched a 307 unit deal, and it's a tougher deal because two factors. Number one, it's a chiller, and number two, you have to assume the debt. So we talked about where is the frenzy right now. The frenzy right now is on free and clear new debt deals, where you can come in and buy it at sub-3 debt and everything. But there's so many of these people that put Fannie or Freddie debt on it, and they have a 4.75 to a 5% interest rate, to where you can put a supplemental on it and get to 70, maybe 73% LTV, something like that. And the supplementals maybe at 4.60. And so those are very tough for us right now. So I think there's opportunity in those. If you could go in and assume, there's a frenzy around new debt deals right now, assumption deals. I do think there's opportunity. As far as location goes, I like to stay in safe markets, not that are the prime markets in a particular market, CMA.
Yeah.
But somewhere that's kind of a mid ground, not in the rougher with the tougher tenant profile, but somewhere that's in a mid area, 70s, 80s, clean deal, good owner operator you're buying it from, so you don't have, issues with tenants in there. And I think assumption deals right now. I think there's opportunity there because so many people are looking at these deals and saying, nah, I want new debt deals, I'm out. And they're not even penciling it to see what the yields are. So I do think there's opportunity there. As far as other asset classes types go, a lot of self-storage, manufactured housing, and industrial.
Stay away from office.
Yeah, I'm not hearing good things about office. I'm just not.
Good luck.
Makes perfect sense. Hey, Chris, I want to come to you real quick. There's a question. I mean, if you want to answer this very quickly, you can, but this isn't the question I had. But in the chat, it's you kind of talked to this, but to get really specific, the San Franciscos, the LAs, they're leaving. When does this become apparent in those markets from a real estate perspective? I think it already has, right? We're starting to see cap rate expansion there, or no, not yet?
Not a ton.
Okay.
And I think the buyers are really holding firm. So. And not to get too long-winded on this, but one of the things that the drop in interest rates has done is it really has stabilized values. Even in those markets where revenue is down, rent growth is down, occupancy is down, owners in the big markets are able to refi. As Julie was talking about, the rates are so low, they're able to lock in at low rates and basically make up the loss in cash flow, make up the loss in NOI. And so their values have stayed the same, maybe 1% up, 1% down, depending on how the individual property is doing. So to some extent, the Fed, and we saw this in 2008, the Fed backstopped assets. They backstopped the equity markets, they backstopped the bond markets, and they backstopped the real estate markets. And that's really what happened again. So the primary markets are flat. The ability to refi are actually boosting values in a lot of these secondary markets. And Julie, I know you and I had a conversation 6 months ago and said, where's the COVID buy going to be? Where's the distress? Where are we going to buy these deals at pennies on the dollar? And I'll be the first to admit, I thought that was going to happen, and it didn't. In fact, in a lot of these secondary markets, the DFWs, the Austins, the Charlottes, the Raleighs, the Orlandos, the Denvers, values are going up, even if fundamentals are staying flat or only increasing a little bit, because as we've mentioned, the debt costs are so low. So I don't know that you'll see a deterioration in values. I think you'll see just a flatlining in New York and LA and San Francisco. And there will be international capital that comes into those gateway markets again. We've seen it time and time again. The Sovereign Wealth Fund of Singapore, the Sovereign Wealth Fund from anywhere, or international institutions will say, you know what, I want to be dollar denominated. I'm going to buy a New York apartment building, Class A, at a 2.5 cap. Whatever, that's fine for me. I just want to hold my money in a US dollar denominated asset. You'll see that in LA, you'll see that in San Francisco, you'll see that in Seattle, you'll see that in Boston, you'll see that in DC, you'll see that in New York. And I think that's really what's going to keep values stable. So I don't think you'll see values deteriorate in those markets, but I don't think you'll see them run up either. Sorry, I know that was kind of a long-winded.
No, that's good. That was great intel. And our friend Ben over here, actually, he's very familiar with international money, and he's preached that to me, what you just said, consistently. So Ben, I think that checks out from your perspective. Yeah.
Absolutely. Makes a lot of sense. Yep.
Yeah. So from a standpoint of unemployment, I want to talk about this real quick, Chris, and then it looks like we got a question. We'll go to Julie and to Terry on in the group here. But Chris, unemployment, trends with unemployment. It's kind of been staved off with some of the stimulus packages, the money that's been put out there. And it's funny, just a quick sidebar. Take me back if I lose my track on unemployment, but quick sidebar on this. I think I lost my track on the sidebar, to be honest with you. Forget the sidebar. Back to unemployment. So with unemployment, what are the trends with this? What do you see happening now that stimulus is kind of wearing down, or the left and right can't agree on how much there should be or should there not be? Spending, I think, has been down recently since the $600 unemployment benefit has gone away. What does unemployment mean in the context of anything? Wherever you want to take that, what do you look at with unemployment, and what does it mean from either collections, cap rates, population trending, where people are moving to? I can't think of the term now, but all of that, like
migrating.
Thank you. Migration. We've said it only 20 times tonight. What does unemployment say to you, if anything, and what you're looking at in the data you look at daily?
Yeah, well, unemployment is certainly one of the key metrics that will drive demand for housing. And on the flip side, it's really employment that's driving the demand for housing. I'll try to unpack it in a couple of different ways, but you did mention the stimulus and the additional unemployment benefits that people were receiving up through July 31st. Those expired, and for the most part, we haven't seen a huge deterioration in collections. Julie, you mentioned a good point. We are seeing a little bit more with the deterioration at the low end, and that's really where most of the job loss was. It was in the hospitality sector, it was in the trade transportation sector, restaurants, hotels, airlines, theme parks, and we continue to see headlines. The airline industry tomorrow hits their deadline for basically the restriction of laying off employees. So I think we'll see a lot of job cuts in the airline industry very soon. Disney just announced 30,000 people laid off from their parks. No one's going to amusement parks right now. Yeah. So that will certainly impact people's ability to pay over the long term. Now, interestingly enough, we haven't seen a huge deterioration of collections, because through July, people on unemployment were getting far more than they had been in the past. So they were able to pay their rent. In August, in September, they'd really saved. It was $600 or $2,400 a month on top of whatever your unemployment benefit from the state was. So they were actually saving up more. And certainly housing is one of the the fundamental things that people will save for. We expect to see, if there's continued deterioration, a very slow deterioration in collection fundamentals. Pelosi and Mnuchin are talking today about another $2.2 trillion in stimulus. Pelosi wants to include another $600 a week. So that would bring collections right back up to where they were last year and in the past. I don't think you'll see a huge deterioration of multifamily fundamentals as a result, because I think, and the concept of governments not spending anymore, in my mind, is completely out the window. Democrats love to spend, Republicans love to spend. It's just where they're spending it, right? The deficit hawk concept is gone, as we've seen this year and in years past. My concern is what's going to happen when the music stops. Our debt is going through the roof. We do have very low interest rates. It's easy to service our debt right now. I don't expect to see inflation. There's nothing driving inflation, at least on the short term. But when we look 8 years down the road, 10 years down the road, I think the music's going to stop. And how are we going to handle this mass amount of debt that we built in 2008, that we built even more this year? And how is that going to kind of ripple through the whole economy? And I think it's going to be huge. I think there's going to have to be significant tax increases. I think there's going to have to be significant inflation. And I think you'll need to see both of those in order to get the national debt under control. But when we talk about more stimulus, in my mind, it's kicking the can down the road. So I don't see a deterioration of fundamentals on a grand scale, on a national level. Maybe it's in the big markets, but really nationwide, I don't see it, because I think if unemployment doesn't continue to grow and grow quickly in a V-shaped recovery, as people are talking about, you'll see more stimulus. You'll see more stimulus, especially because we're in an election year.
Interesting. No, that's very interesting. Yeah, we'll see. Right. And like you said, kicking the can down the road, it's at least that. It's a little bit scary what this number is trickling up to and what the impact of that is going to be. And you mentioned about, continued inflation to kind of keep track with that. And I think it goes to the next question that, Julie, I think you're the best one to answer, but if anybody wants to jump in and chime in on this one, I'll let you. But Julie, let's go with you on this. This is from Kabi, I think is how you say the name. Can we conclude that there's really no housing correction coming? Those of us waiting on the sidelines to buy is a bad idea. And again, no one has a crystal ball. I want to make sure everybody knows that. We don't know. But before, you mentioned about inflation keeping interest rates very low. 3 years was kind of floated, but yeah, things turn around. We could start to see interest rates creep up. I think that's where you see your correction, right? Definitely, no doubt.
Yeah.
So do we wait for that? Or are there other variables that you see? And again, I'll go around the horn on this if anybody wants to chime in after you, Julie. Are there other variables you see that may contribute to a housing decline in the short term?
I think that when you talk about a decline, are you talking about the money that?
Yeah, I think people are saying like, look, I'm holding cash because all the asset values are going to drop. Residential, multifamily, cap rates are going to expand. Everything is going to go down, and then I'm going to buy, just like post 08, right? I'll give you my theory. I think small business is more the place to that's gotten killed. Like multiples are way down post COVID or in COVID, more than real estate like it was in 08. I think people just assume like it just repeats and real estate's always the opportunity after every downturn. I think it's more small business now than real estate. And we've talked about, hey, integrate, buy an HVAC company to put into your vertical integration with your 2,000 units or whatever. That might be the better play right now or going forward. But the question is rooted in this idea, and you hear from a lot of investors, I'm holding my cash. It's close to me. I'm hoarding gold, cash, all of that, because I'm going to buy when this all comes crumbling down. And they expected that would be 12 to 18 months out from COVID starting. I don't see it happening in 12 to 18 months personally.
I don't. It's hard for me to get a hold of it. Like, is it really going to happen? If we're talking about stimulus packages going out there, quite frankly, that's just a key to keeping peace, and I think there is some value to that. So if we can keep people paying their bills, there's people are not spending like they did, so they are hoarding money. And so I think there will be a little bit of a correction, but are we talking about what we saw in 2008? I don't think so. I really don't. That's my opinion. My crystal ball, the guy keeps flipping me off, so I don't ask him any more questions about that.
But
Terry. I would say that's really, we're really going to see, I think 2022 is where we're going to understand really the impact of this. I think there is a threat that a lot of people got into these deals 2 years ago, 3 years ago, where the interest rates were, as Bart said, we're seeing things like they're in yield maintenance and they want to get out of them, and it's costing them $1 million to get out, and they can't get out. And so they want to do an assumption, and that doesn't make sense. And so there is a question like, how do we keep this running? Are we going to go to our investors and ask them for a capital call? I think that there is a threat of that. I do.
Okay.
There are a lot of people out there looking, but are they going to be able to pick up and pay for that yield maintenance penalty? Or are they just going to walk away? Is that owner going to walk away and just say, here, we can't do this?
So Bard, what she's speaking to in my mind is supply increasing, right? And meeting the demand. I don't know, is that possible with what you're seeing in the next 2-3 years outside of a deflationary event?
I don't think so. I don't think so. I don't think there's going to be an issue. I don't think prices are going to drop. Everybody was waiting for it through this. And I just don't think, I think the fundamentals are still too strong. I think there will be some people that will have to tighten their belt that have delivered ridiculously good yields through this cycle. And I think the yields are just going to get skinnier. And I had a long conversation with a good client the other day about this. And so, their investors, they're just telling them, yields are not going to be as strong as they were. They're still going to be good, but they're not going to be what they were before. So you just kind of have to change your perception of what you're looking at on these deals and say, look, it's not going to be like it was. And that's okay. But I haven't seen a lot of people in trouble yet. I haven't seen prices dropping. I think some people will take a little bit of a haircut. We saw probably 1 to 4% maybe in the middle of COVID. And so now that's back up and that's down to 1 to 2% or something like that. So a lot of people were looking for some big drop that are sitting on cash at 10, 15, 20%. That's not going to happen.
Yeah.
I don't see
one
Yeah.
on the yield piece. There's this one guy, he's I think it's Core Solution, something like that, keeps barking about bonus depreciation. It'll increase your yield, it'll increase your returns. He's annoying, but we'll get to him in just a little bit. So Chris, how about you? What do you say about the potential of a correction or drop in the housing market?
Yeah, I really don't see it until maybe we see interest rates, but the Fed has said they're not going to raise interest rates for a while. There's no indication of inflation on the goods or the services side, so there's no reason really for the 10-year. There's nothing pushing the 10-year northward, and I think you'll see the same debt spreads remain where they are, and so. As I said earlier, the drop in debt cost is really backstopping these values. And if we see NOI start to increase, I think fundamentals will come back before interest rates do. You could see the values really continue to go forward before they even take a minor step back. So if anyone heard me or heard any of our webinars back in March, we were saying, yeah, we could see 10, 15% declines, Bard, to your point, but we didn't see them, and I don't expect we'll see them now.
Okay. It's interesting. We'll see what happens. I mean, none of us again know exactly what the future holds, but it's going to be an interesting ride. I think it was it guns, grub, gold, and ground at the beginning of COVID. Those are the 4 G's to buy. And those that were sort of doomsday preppers have sort of backed off of that a little bit. Some big names, smart people had that perspective. So we shall see. God, we have a lot of questions, not a ton of time. But Terry, I want to go over to you because this question comes up a lot. And thank you for letting me bust your chops. You know I love you, by the way. The question is, what size of property or what size of portfolio or whatever it may be, should people start to think about a cost seg analysis?
Well, now it's changed. $500,000 is really the minimum now. It used to be about $1 million. So with the new tax laws, and we're doing bonus depreciation now, which really drives the land improvements really drive that 100% bonus depreciation number. So now it's 500,000. Even so for newbies coming into the market, they're always asking like, what's the sweet spot? What's what makes economic sense? You buy a property over 500 grand, even if you own a bunch of multifamily real estate investment properties that add up to about 500,000, talk to us because there could be some cost seg opportunities even for your single family residents. Just FYI. I
think that's big. I think that's an important part that a lot of people don't think about is their whole portfolio is actually available for this. There was another cost seg question. I'm trying to find it. We've got a little bit.
Can I ask a question, Jamie?
Yeah, go for it, please.
So Terry, you got a property, you sell it in 2020, you do a cost seg right before you close it. Can you go back and use those couple last years, or do you have to continue to own it beyond the
The
cost
only
segregation.
opportunity is if your tax year is still open after you dispose of the property, there could be some opportunity. If you've closed out your tax year, you've lost that window because it's now gone to the next ownership.
Okay.
And they're going to be able to use, the cost seg from day one again. So
Okay.
you also got to kind of work. There's always there's something called recapture in the midst that's lurking behind the weeds.
That was the other
Yeah,
question,
that was
Terry.
the
So go
question. Yeah.
talk about that. Talk about recapture.
I'm futuristic.
Yes.
So you just got to be careful. There's a timing window when you're talking to do the cost seg. One of the reasons why you would not do a cost seg is if you're going to hold that bill or sell that building before 3 years. So if you're going to flip that building, it's not going to be a long-term hold. We advise our clients a 3 to 5 year hold time, minimum, to really leverage that time value of money, because the IRS will want some of that depreciation back in the form of recapture on the next purchase. So you just have to, there may be an adjustment. There is some planning around that I'm not going to go into it because of just from time's sake here tonight. But there is some planning that we help our clients work through, which can mitigate whatever that recapture would be. And we're just booking more of the value to real property as opposed to personal property, because now that personal property, that's what we're cost segging, by the way, has a declining balance. And we want to get that down to zero so we can mitigate whatever recapture would be available. So great question. And hopefully that helps a little bit.
It does help. It helps a ton. I think the takeaway on the cost seg part is, it can be a part of your upfront due diligence. It should be a part of your upfront due diligence, and we'll get your information at the end of this, Terry. And who knows what the future holds forward, or exactly how much of it you can leverage. It's such a great thing right now. And as you see returns declining, it's a great way to juice them, in my opinion. That's maybe the wrong way of putting it, but that's just my opinion. There was a question in here about eviction moratoriums. Here we go. Do you think, and I don't even know, I'll be honest, like the question is, do you think it's possible once the eviction moratorium is expired and a lack of stimulus, we could see a flood of evictions and therefore a lot of turnover expenses? I don't know why I didn't think about the eviction moratorium and the impact, but I'm going to start with you, Bard. What, if anything, does the eviction moratorium expiring, or even the fact that it's in place, what does it mean for buyers, sellers, the future of the market, if anything?
Well, sellers are looking at it as, they're just waiting to be able to just hammer it and get all these non-paying tenants out of there. I think the way buyers are looking at it, they're not looking at it as such a negative situation. I think they see that, look, it's going to be an opportunity. They're going to be able to get these tenants out of there right when they hit the button and say, you can go ahead and evict these people. And they see it as an opportunity to go in and update those units and have a plethora of units. It's not a lot. It's 4, 5, 6 units on a 150, 180 unit deal that they're consistently not paying the rent. They're going to get them out of there. They're going to go in and they're going to update those units. And then now they're going to charge $125 premium on those units anyway. So they understand it's going to be a turn of the key, and that income is going to be back in place. It's not something that you can look at for the next 12 months that's going to be an issue. They're going to get them out quickly, and then they're going to get that revenue back.
Chris, any thoughts on evictions from a property management, I don't know, data migration, anything that you can think of with evictions, or not really relevant for you?
Yeah, no, and I would just kind of echo Bard's point to say that it's not as widespread as some people are making it sound. And again, going back to the stimulus, going back to the collections, they're pretty good. Are some people gaming the system, or are some people unable to pay and not paying? Yes, absolutely. But it's a minuscule percentage of the overall renter base. So I don't think all of a sudden, if the evictions end 12/31, or if it gets pushed into the spring, whatever it might be, I don't think you'll see, this fire sale taking place in many markets across the country. It'll be, if anything, on the margins.
Beautiful. Well, this has been extremely informative. We only have a few minutes left, and I wanted to make sure folks out there know how to reach you, how to get in touch with you. So let's go around the horn. Julie, I first want to say thank you for bringing Chris and Bard to this. I apologize, Bard. This has been fantastic, incredibly informative, and I have a couple more people in my network, so thank you for that. Julie, why don't you tell us a little bit about how people can get in touch with you, and we'll go from there.
So a couple things. I have a Zoom at 8 call on Tuesdays, and you can come join us. Check out my Facebook and LinkedIn. You can reach me through there or call me 972-833-2774 or an email jpeterson@oldcapitallending.com. Thanks.
Beautiful. And again, thank you, Julie. Tons of great information. Mr. Judge, how can people get in touch with you and CORE?
Yes, sir. You can reach out to me on LinkedIn. Do not reach out to me on Facebook because I have been hacked and Facebook no longer recognizes me. It's been a train wreck to get back my account and my identity.
Yeah.
Terrible.
Right, Jamie? It's just a shame. Can you imagine that? If you lost your Facebook, you'd be dead.
I don't know what I do. Yeah.
So I'm working on it. I have to get something notarized. I have to get something sent in. It's been a nightmare. So let me give you my number, 248-210-4843, 248-210-4843. Jamie knows how to get a hold of me as well.
Of course.
Let me just give you a quick, my email, tjudge@coreadvisors.net, tjudge@coreadvisors.net.
Beautiful. Thank you again, Terry, for being on tonight. Great information and a lot of questions about cost seg. So that's amazing. Bard, how about you?
Okay, so one way is to go to our website. It has a contact information for me and everyone on our team. It's very simple, www.multifamilyadvisors.com. We locked that one up early. That was pretty good.
That's pretty good, yeah.
Yes.
I like that.
And so, but my direct email, bard, B-A-R-D, .hoover @marcusmillichap.com. So either way, you can get in touch with me, and my telephone number's on the website, or you can email me.
Beautiful. All right. Thank you again for being on here. Again, fantastic information.
Thank
It's been
you.
fantastic
Thank
meeting
you.
you as well. Chris.
Yeah, so email is the best for me. I know the email is going to be a bit of a mouthful, but it's my name, chris.nebenzal, Nebenzal, @yardi, yardi.com. Email is best for direct contact, but I would also point you towards yardimatrix.com. That's our public-facing website, yardimatrix.com. You can see all of our public reports. We do market level reports. We do national reports. Like I said, we cover a number of different asset classes as well. And all of our old webinars are up there as well if you'd like to listen in.
Beautiful. Amazing. All of you. Ben, what'd you think tonight?
I guess my biggest takeaway from tonight is that there's really a positive outcome for multifamily. I believe with everything, and we have solutions like cost segregation that are apparent to, help the yield that might be a little less interesting than the previous years, but there's a bunch of opportunities still to come. So.
I love it. And yeah, multifamily just seems to be, and the commercial side of things, at least, it always seems to be the place where it's not going to go away. It doesn't go away. It's always the strongest, in my opinion, of all the asset classes. People want less stuff. Storage goes away. They don't want to go to offices. Office goes away. Retail's seen its problems and it's going to continue to. So multifamily is the sexy sector, I like to say. Actually, I've never said that, but now I like to say it. And I think it's going to continue to be that. Ben, by the way, in honor of you, my friend said grub, gold, ground, guns, and croissants. So all of those are essentials to buy, especially if you heat them up, which, inside joke, Ben thinks it's stupid to heat up a cooked croissant, but he's French. He's allowed to think that. I'm off the rails. I appreciate all of you coming on tonight. Thank you so much for doing this, all of you. Thanks all of you who attended. YouTube.com/multifamily more. It should be up on Friday there. Share it with everybody you know. I think this is incredible information for anybody who's thinking about, all the way up through a seasoned investor with thousands of units. It works for all of them. So thanks again to all of you. I appreciate it. Have a wonderful evening, everybody, and we'll see you next month. Thanks,
All right.
everyone.
Thanks, guys.
Thanks, everyone.
Jamie, thanks, Ben.